But if you didn't understand the company, if you're just buying on the fact that the stock went from $16 to $26 and then again at $10, what will you do when it goes to $9? What will you do when it goes to $8? What will you do when it goes to $7? This is the problem with people, is that they sell stocks that they didn't know why they bought them. Then it went down and they didn't know what to do now. Do you flip a coin and walk around the block? What do you do? Hello and welcome to the channel. Today we'll be talking about Peter Lynch's methods to make millions in a market crash. He's heralded to be one of the greatest investors in the history of the stock market, Peter Lynch. He's a world-renowned mutual fund manager at Fidelity Magellan Fund. In his time, he achieved a 29% annual return. It was staggering numbers for a professional in the middle of uncertainties of the stock market. He did it for 13 years continuously, and that's hugely impressive. The fund's size during his tenure will grow from $18 million to $14 billion. He had been so successful that he retired at 46 years old. He's now spending his time sharing his success with everyone else. Lynch has written 3 texts on investing, one up on Wall Street, Beating the Street, and Learn to Earn. The last named book was written for beginning investors of all ages, mainly teenagers. In essence, One Up served as a theory while Beating the Street in an application. One Up lays out Lynch's investment technique, including chapters devoted to stock classifications, the 2-minute drill, famous numbers, and designing a portfolio. Most of Beating the Street consists of an extensive stock-by-stock discussion of Lynch's 1992 Barron's magazine selections, essentially illustrating the concepts previously discussed. As such, both books represent study material for investors of any knowledge level or ability. Lynch also wrote a series of investment articles for Worth magazine that expand on many of the concepts and companies mentioned in the books. I found that when the market's going down and you buy funds wisely, at some point in the future, you'll be happy. You won't get there by reading. Now is the time to buy. Lynch coined some of the best-known mantras of modern individual investing strategies. His most famous investment principle is, invest in what you know, popularizing the economic concept of local knowledge. Since most people tend to become experts in certain fields, apply this basic invest in what you know principle helps individual investors find good undervalued stocks. Lynch uses this principle as a starting point for investors. He's also often said that the individual investor is potentially more capable of making money from stocks than a fund manager because they can spot good investments in their day-to-day lives before Wall Street. Throughout his 2 classic investment primers, he's outlined many of the investments he found when not in his office. For example, in One Up, Lynch explains how he invested in Dunkin' Donuts, not after reading about the company in the Wall Street Journal, but after being impressed by their coffee as a customer. Assuming others would be similarly impressed and noting the company's Boston locations were always busy, he then studied the company's financial status and decided to invest in Dunkin' Donuts, which proved one of the best performing stocks he ever bought. Lynch believes the individual investor can make similar smart investing choices by noticing particular opportunities like Dunkin' Donuts or paying attention to business trends in their careers and hobbies. Using examples from Magellan Fund, his books outline how a novice should read and interpret company paperwork for information on stock valuation, earnings, cash flow, and other data. Lynch has stated in One Up on Wall Street that his undergraduate studies in philosophy and logic were more important to his career than the math or finance he studied for his MBA. At Wharton, he came to believe that the 2 prevailing investing theories in academia, the random walk hypothesis and the efficient market hypothesis, were contradictory. The concepts taught by professors at school were regularly disproved by professionals during his internship at Fidelity. He thus came to rely more on practitioners than theoreticians. It seems to me that what was supposed to help you succeed in the investment business could only help you fail. Quantitative analysis taught me that the things I saw happening at Fidelity couldn't be happening. Lynch has also argued about market timing, stating, far more money has been lost by investors preparing for corrections or trying to anticipate corrections that has been lost in the corrections themselves. He also coined the phrase 10-bagger in a financial context. This refers to an investment which is worth 10 times its original purchase price and comes from baseball, where the number of bags, or bases, that a batter can run to is a measure of the success of that runner's hit. A baseball player who hits a home run will pass all 4 bases, and so such a hit is sometimes called a 4-bagger. Similarly, a baseball double hit is sometimes called a 2-bagger. As Lynch wrote in One Up on Wall Street, In my business, a 4-bagger is nice, but a 10-bagger is the fiscal equivalent of 2 home runs and a double. During the stock market crash, there's one important factor that a person must keep in mind, that is to study history. It's the most trustworthy source you can derive your lessons from. Here is what you can learn from history when the stock market falls. It will keep spiraling deeper and deeper and hit lows for quite a while. If there have been 93 years in the century thus far, and the market declines by 10% or so around 50 times in this time, on the average, the market will decline once every 2 years, with the fall being more than 10%. It is referred to as a correction. It's just a rewording of losing a great amount of money that's invested in the stock market. Then it needs to be noted that out of 50 declines, 15 times the market has fallen below 25%, thus becoming a bear market. Again, simple math shows us that every 6 years or so, the market will turn into a bearish market and drop below 25%. Just remember these patterns. At the end of the day, the market is bound to go down some or the other day, and if this fact is ignored, owning stocks is more harmful than not owning them. It's not a bad omen at all if you think about opportunities that come along when there's a crash in the market. A stock that you prefer will come for $6 from what it's priced would have been in normal market conditions of $14. If you understand the market and the company whose stock you buy by looking at their performance on the balance sheet, you'll realize that it's not doing anything bad. Now, under the normal market, you would have reached from $14 to $22, which is a good return. Imagine the market has crashed and the stock prices are much less. It can go from $6 to $22. You need to take advantage of declines as they can boost your returns on investment. They're going to decline, but no one can predict them from happening. Understanding what you own means that you'll know when you're at the advantage. There are many investors who will buy a stock based on intuition along the lines of, if a stock has gone down a certain percentage, then how much further can it go down? An astute example can be that of a Polaroid. When its share price started to fall, people waited for it to fall before they attempted to capitalize on the low price. They felt that there would be growth in the future. They looked at it and said once the price starts to fall below $100, we'll start investing. Then the price share fell so hard that by the end of the year, prices had hit an all-time low of $18. The company had no debt at all and the share price was overpriced, that the share was bound to go down. The same was the case with Kaiser Industries, who held 40% of the shares. They had 40% of Kaiser Aluminum and almost 32% of Kaiser Cement. They had also investments in broadcast, sand and gravel, and engineering, and owned the automobile company of Jeep. The company too had no debt in its financial structure. After all, it's very hard to go bankrupt when you have no debt. The company at $3 was selling at $75 million. They gave away all their shares to their shareholders. Of all the companies that were held by them, this share was distributed. They were getting about $50 a share. He says he loves the volatility of the market. He tells the story of the year 1973 when the Taco Bell shares dipped from $14 to $1. Even though the company didn't have any debt, nor did they have a restaurant of theirs closed down, they went on to buy the share when it hit $7. He stuck with the stock even when it went to $1. The fund he managed, Magellan, had reached the largest position in 1978. When it was bought out for $48 by PepsiCo. He believes that the stock could have reached $400 if not for the buyout. He believes that callers are very important. It isn't good when there is too much volatility for the public, and therefore the limits on the same are important. Then it's to be noted that the market will go up and down. There will be some or other left field events that will alter the market. Hence, volatility cannot be stopped, but then it's an opportunity for the investor. You need to know what you own, and there's no other way out. After all, if they don't want to know what they own, then they can try mutual funds. Once again, going back to history, it can be easily observed that basic corporate profits have gone up by 8% a year. Hence, they double about every 9 years, again using simple math, which pushes the stock to also double every 9 years. It's then easy to expect that market, if it's 3,800 today, then there will be up and it will not go down. It might not be easy to predict what will happen for the next 500 to 600 points. After all, history tells us that the market will double up in the next 8 to 9 years. Profits will rise 8% every year, and the stocks will fall as simple as they can be. He speaks about his experience in October of 1987, when he was convinced about the stability of the market. He didn't worry about the market and it hurting its investments. He even decided to take a vacation to the country of Ireland to play golf with his wife. He left for his vacation and the market fell 55 points straight away. When he landed in Ireland, he got the shocking news when he called his office to learn that the market had gone down even more to 112 points. He still decided to stay for the weekend and hoped for better news from the market in due course of time by the following Monday. Then on Monday, the news hit him that the stock market had fallen 508 points. This affected the fund handled by Peter Lynch by quite a negative margin. The fund went from 12 million to 8 million in a few days. It was so drastic that if the trend continued by the end of the week, he would end up exhausting his fund. After all, it was the whims of the market that were taking a toll on the fund. There was not much that could be done by him. Due to the time difference, there was a bit of a delay, as in Ireland the time was already 12 o'clock, while New York was still running at 7 o'clock. He played a bit more golf to kill time and then started to keep track of the market. There were no signs of improvement from the market at all. There was nothing that could be done but to wait and watch the market hopefully improve. The shareholders of the firm were also getting worried, as it was, after all, their money being washed down by the drain due to the sudden downfall in the market. It was just going to be waiting and watching. He claims that despite his record, whenever the market went down his fund, the Magellan also went down. It went down 9 times in 13 years, following suit with the market, which also has just as many downfalls. At the end of the day, if you put $1,000 in stock, you'll end up losing just that $1,000 and nothing more. If you made the right call, then you might end up with $10,000 or $20,000 or $30,000. Make sure you know the company you've brought in and out. If they're doing all right and doing everything else right, you'll add to their success. Selling a stock when it faces slight turbulence is just a tragedy. At the end of the day, the market is bound to recover and rise to a level where it's better than before. It's like tossing a two-headed coin where the head stands for growth. A long-term investor who's ready to play the long game and thwart the fall in the market would do well with stocks.